I will never, ever, ever buy on a best case scenario for obvious reasons.
We have a really exciting guest today. His name is Alex Pardo. He is a self-storage owner, operator, and expert coach where he helps people buy their first cash flowing facility within 6 to 12 months.
Oftentimes, I won't even buy on the likely scenario. Even though I'm confident I can achieve that, I'll buy on the worst case scenario.
Is that part of your coaching program too, the operations side of storage, or do you just help people on like sourcing and structuring the deals?
We have a three-phase system where we call it deal discovery, which is how to find the deals, how to underwrite them properly so you have confidence to make an offer. Operations, if you suck at operations, then you shouldn't be the operator, you should find the right operator.
Hey guys, it's Tyler Casey back here again for episode 16 of the Ideas and Capital Show. We have a really exciting guest today. His name is Alex Pardo. I think we'll let Alex tell us a little bit about himself.
You're good, brother. Number one, thank you for having me on, man. I'm excited to be on the show. I love what you're doing and all the great content you're putting out there. I'll give you the super Cliff Notes version. When I got back from traveling from Europe, the pain of going out and getting a job was a lot higher than anything else. So I was very, very motivated to go out and start something. I felt like I was wired to be an entrepreneur. I just didn't know what that looked like. And as a result of reading the classics, the Rich Dad, Poor Dads of the world and E-Myth and all those kinds of books when I was on the train in Europe, I committed to get into real estate. The irony, Tyler, is I got into real estate, I would imagine like many of your viewers and listeners, because I wanted freedom. I wanted options. I wanted, cash flow and all the benefits of real estate. I ended up becoming a wholesaler. And I did basically, it was just transaction after transaction after transaction. And I remember fast forward 2016, 2017, I look up and I told my wife, I said, this business has been great. It's been a cash generator. We've been able to make and generate a lot of income, but where are the assets? I felt like I kept having to wake up and go chase another deal. And every single month I was starting from scratch. At this point, I had built a team and my overhead had ballooned to roughly $40,000, $45,000 a month. And that's not really the vision I had. I wanted simplicity. I didn't want a huge team. I didn't want a bloated payroll. I didn't want any of that stuff. But because I was involved in some high-level masterminds, I saw other people, quote unquote, scaling. And so I decided, okay, well, if they're scaling, I should scale. But I scaled irresponsibly. And I made a lot of mistakes, learned a lot of lessons. And so we started buying single-family rentals. And after about 5 of those, I realized, okay, yes, this can be a way to generate wealth, but this might be controversial. What I experienced is that owning rentals wasn't about the cash flow. It was about the tax benefits and depreciation and appreciation if you held it long enough. I didn't want to manage all these tenants and deal with the management and toilets and everything else. And at that time, Tyler, I happened to be coaching somebody who owned a storage facility. It just opened my eyes to the asset class. Everything that I wanted in real estate was wrapped up in storage. It was a business with the benefits of real estate. I didn't have to deal with tenants and toilets. Obviously offered, when you find the right facility in the right market, cash flow and tax benefits. I could go on and on as to what really opened my eyes to the asset class. But yeah, man, I decided in 2019 I was going to start to unwind the business I had built of wholesaling. And when COVID came, it was a blessing in disguise. I had zero desire to pivot, which was the word that was being thrown around at that time, left and right. And later that year is when I committed to pursue self-storage.
Well, my main business is property management, so I totally understand. We have a fund, so we do our own real estate investing, a ton of it too, but we also have the biggest part of our business is third-party property management. I've invested in some storage myself. At one point had 3 facilities here in Joplin, Missouri that were about 1,500 units in total, and with a couple of partners, and we exited those in 2025 actually, so the beginning of last year. One of the best investments I've ever done though. I'm totally on board with storage. Were you buying your long-term rental properties in the South Florida area?
No, because obviously in South Florida, just the rental rates relative to the prices made 0 sense. So one of the relationships I built in this mastermind I was in, this gentleman owned a very, very large rental portfolio in a Class B neighborhood of Cleveland, Ohio. So I was buying in a neighborhood called Parma and Parma Heights. I was building by living here in Miami and working with third-party management. I was leveraging the skills that I've acquired in terms of direct mail and how to source off-market opportunities. And it wasn't that I had a bad experience building a rental portfolio. It just felt like another version of a slow grind. And it's interesting, but a lot of people that I know that had at one point large rental portfolios, many of them are scaling down. I think they've calculated their return on equity and realized like, hey, I want simplicity. Let me scale down and take this capital and put it somewhere else. So again, I'm not going to be the guy coming on here saying, hey, self-storage is better than this and that. Like, you can build wealth and live an amazing life with all these different asset classes. I think for me, it just aligned more with my goals and the vision that I had moving forward.
From my experience with it, definitely lower maintenance, less sending handyman and plumbers and electricians out to do things. I would say the only thing that's more challenging about it than long-term rental properties, in my view, is that you are sort of constantly having to follow up with leads and do new leases with people to keep the occupancy high. Whereas with like a long-term rental, you rent it once a year, maybe. Like in our system, that person stays on average 2 years. So it's just maybe a little easier management in that way. What you were saying is totally true. I mean, I have some clients who are doing that. I actually just had a podcast episode with Henry Washington last week that just got put up on, Spotify, Apple, Amazon, all the places, YouTube. And we manage his long-term portfolio for him. So I've helped with some of these exits because he's been sort of selling some off and paying down other ones that he has. He said exactly what you said about he got into the trap of scaling and growing and buying doors because that's what all the other people around him were doing. And then he realized after he bought 130, that was not what he really wanted to do.
It's interesting. I'm 46, but the older I get, the more simplicity I crave. I would rather a solid, smaller portfolio that's paid off than a larger portfolio that's fully levered. And then I get the math. I don't want more weight and more debt. I think it back to everybody's got a different vision. And I think you have to follow what is going to align with what it is that you're looking for. And oftentimes I find in the real estate investing world that goals don't align with the path that people are on. Or sometimes people are thinking short term, they're not thinking long term. And then to your point, 100%, self-storage is an operations business. One of the things I like that some people might look at and say, oh, I don't like that. I like the fact that we can revenue rate manage, right? Like every single month we can adjust rates based on what's happening in the market versus like if you have a single family home and you're renting it out, unless it's a short-term rental, whatever that monthly rate is locked in for a year or however long. And so you do get the benefit of being able to really push rates and generate more revenue. But to your point, one of the biggest risks that I find in self-storage, Tyler, is buying a facility in a market that doesn't have strong demographics and maybe doesn't have enough demand for storage. Then that can be an uphill battle in terms of constantly chasing, like doing the marketing and the leads to increase the occupancy and generate more revenue. It's super, super important. Like economics 101, you have to be in markets that have strong demographics and that have more of a demand for storage than the available supply in that market.
There are pretty credible resources for like having studies done for a 3-mile radius study that you can have done to see what the storage demand would be like. I assume, do you do that when you buy a deal?
100%. I hate to use industry jargon because I prefer to just like I'm talking to a fifth grader type of thing, but there's something called square foot per capita, which is basically the ratio between the total available net rentable square footage in a given 3 or 5 mile radius relative to the population in that area. And the national average is 7. But to me, I think sometimes that's over indexed, meaning people put so much weight on the square foot per capita or the supply index being a little bit higher than that sometimes people kill deals when, in my opinion, it's an important piece of the puzzle, but it's just one piece of a greater puzzle.
I mean, like the 3 facilities we bought, we didn't do a study. But to me, it was fairly obvious, like the one we bought in Webb City was right across the street from Webb City High School and right outside the gates of a really nice brand new large housing development that had just been built. And then like the one we bought in Carthage, Missouri had some cold storage and was right across the street from a cheese factory. So like a lot of our space actually got leased to the factory across the street.
That's amazing.
And then the one we bought in Joplin was right next to the biggest luxury apartment building in the city of Joplin. It was literally across the street. So it was kind of pretty obvious. I didn't really think it needed a study because of the convenience of it relative to so much housing and commercial stuff.
And not just that, Tyler, but I think it's pretty easy to just poke around in a particular market. If you go to competitor websites and you see that they have waiting lists, that is a pretty strong indication that there's a lot of demand for storage in the market. Now, conversely, if you go to a bunch of competitor websites and you see that they're all offering promotions, that can tell you the exact opposite, that they need to offer promotions to incentivize people to come in and rent units. That could potentially be an orange or a red flag. It's really important that, unfortunately, like you guys are pretty savvy savvy, so you saw clear indicators that, hey, this is a good deal. I would always recommend just making sure that you know what's going on in terms of the demand and supply in a particular area.
We'd had a big private equity group that had been, since we acquired the third one, had been just banging our door down all the time trying to buy these things. There was a bunch of new supply that hit the Joplin market the year prior, and we really hadn't felt it yet in occupancy, but we were starting to feel that we couldn't push price. And before that, we were always able to push price. We called them back and said, you can buy it at that price you offered us if you want to. And it was a great deal for us.
When you told me private equity, I was thinking you probably got a premium and sold at a lower cap rate than had you not sold to private equity.
Oh, much lower. Everybody who was involved in that deal made at least $1 million. I mean, it was a good one. Yeah.
Good for you. I'm just curious, how long did you guys own and operate that one for?
First one we owned for 4.5 years. The second one we owned for 3.5 years. And the third one we only owned for like 2. They were all acquired independently.
Good for you, man. This is your podcast. Now you got me super curious. Is more storage on the radar? Like, is that going to be part of your plan to continue building your portfolio, or was that kind of like a one and done situation?
No, 100%. I would prefer to invest in storage with an operator, somebody that understands the business and has all the systems and automation and all that set up, or can get it set up with a facility. So I would definitely consider being a limited partner or co-GP or something in a storage deal with an operator. Opposite's true with multifamily or like larger single family portfolios. I would probably never invest in somebody else's deal where I wasn't the operator.
Well, man, you and I both know probably a bunch of people that it's like a bloodbath out there. Like the multifamily syndicators are getting killed.
Yeah, it's ugly, especially the guys who raised a bunch of money and bought deals from 2020 to now. Probably if they bought them, 2024 to now, and they're good operators and they wisely perform their due diligence and underwriting, those deals are probably mostly fine. It was all the ones that were underwritten when interest rates were 3 or 4%, and they were done on IO debt or balloon debt, and now those balloons are coming due and the IO periods are ending and they're getting repriced at, 7% or 7.5%. There's a lot of well-ran buildings, a lot of great assets that our people are losing right now. LPs are losing all their money in some of these cases.
That's so painful to me, man, because to me, if you're going to take on investor capital, like, you better treat it better than your own capital. And look, that's not to say that we all make mistakes. Nobody's immune. What I struggle to understand is how can you underwrite a deal expecting that low 3-4% interest rate to not adjust at some point? You know it's coming. Now, nobody knows when, but you know it's going to go up. It can't keep going down. And then to not have an exit, it's rough, man. It's rough.
Well, on a lot of my deals, and I'm with you on that, and I was afraid of interest rates going up. And so I actually did something on a large percentage of our portfolio called a debt swap, essentially where you arbitrage interest rates. And you can fix rates for up to 20 years with these things. And they do it on the SOFR rate, which is the overnight funds rate that banks lend to each other on, which is usually like 2 to 3% lower than prime, which is what they're normally lending on. I locked in a ton of debt, like $15 million worth of debt on our portfolio, under 5% interest for 20 years. And right now, all those bets that I made that interest rates were going to rise, they're all ahead. So if I exit any of those assets right now, the trader on the other side of that bet would have to pay me 6 figures on every deal we locked in. You could have made that bet the wrong way, and then rates went down from there, and then I would owe them money if I exited the asset. But it wasn't likely that rates were going to go down from 3%. I'd actually never done a deal that was bigger than about 25% of my net worth at the time that I pulled the trigger on the deal. And a lot of people are like, that's crazy, that's limiting. And there are a lot of operators that'll go out and do multifamily deal that's 10x their net worth or 100x. They'll go do a $50 million deal where their net worth is 100 grand. I know I get them successfully stabilized, operating, servicing debt. And then I know that capital's not needed in that deal anymore before I move to the next one. Because I've put myself in a situation before where I underwrote a deal for the rehab budget to be X amount of dollars and it was 30% higher than that, or I've underwritten a deal where I had the appraised value at X and it came in 10% lower than that. And you better have the cash when that happens.
100%. And when I underwrite these storage deals, I always like to look at 3 scenarios. What's my likely scenario? What's my best case scenario? And what's my worst case scenario? I will never, ever, ever buy on a best case scenario for obvious reasons. Oftentimes, I won't even buy on the likely scenario. Even though I'm confident I could achieve that, I'll buy on the worst case scenario. Now, it's a fine line because you can be so conservative that then you don't even like get a chance to step up to the plate and swing the bat. I think some of this comes with a little bit of experience looking at enough deals, but making sure that you build in multiple exit strategies. I always determine the exit before I enter the deal, and I want to make sure I have at least 2 exits. If I plan to refi and rates are not we're at a point where I can refi, okay, what else can I do? I can always sell. If I sell, is there enough spread? You got to look at all these scenarios, but it's interesting, man. And sometimes I see people like really push the envelope and get aggressive. And I think it just speaks, Tyler, to people's like risk profile. Some people are, man, they're just riverboat gamblers. They're pushing all their chips to the table. It sounds like, you know, you and I are probably a little bit more on the other side. I love that, the fact that you've created a rule for yourself. That you're like, hey, I'm not going to invest in something more than 25% of my net worth. Are you limiting yourself to a certain degree? Yes, but who cares? You can't put a price tag on like security and like
Being
a
able
good
to
night's
sleep at night.
A mentor of mine always says his definition of success is a good night's sleep.
Absolutely.
That's it.
The biggest deal I've ever done is $4.7 million. It's the biggest deal I've ever done. I feel like if I screwed something up on that deal, I can figure out how to come up with the equity to cover it up. And, you know, once I get done with that $4.7 million deal, I might, you know, cash out, refinance, and go do another deal the same size. And I just keep going and doing more volume of smaller deals, which I think also kind of reduces your risk being in more assets. I know a lot of gurus are out there telling people like, you got to go buy the biggest asset you can get your hands on. That's where all the money is. And that's, you know, scale and simplicity. But gosh, if you screw it up.
You said something that to me, there's so much wisdom in it. You said something along the lines when I asked you about like, hey, are you one and done with storage or are you looking to build a portfolio? You said, I'd rather do it with the right operator. And that was just kind of like said, and like we kept blowing past it, but that's what I'm hoping people pick up on. If people get nothing else out of this conversation, but they get that, the fact that you can do bigger deals, but figure out where you can add value, where you have a unique ability, a skill set, where there's aptitude and confidence and competency in a certain area that you bring, and find, like, bet on the right jockey, not just a horse. When I look at a deal, I'm first looking at the operator before I even look at the asset and the deal. Both have to work because it could be a great deal, but if there's not a core value alignment, integrity's lacking, it's just not the right operator, I don't care how great the deal is, like, I'm not interested. Conversely, it could be a great operator, but if it's just a crappy deal in a bad market, like, it's probably going to struggle. So you need both. And I think oftentimes too many people are infatuated by the returns on a spreadsheet, not taking into account all these other things that are really, really important.
Well, man, the way a deal's operated plays a big role in what the eventual returns on the real P&L will be, right? I mean, I can throw out pro formas all day that look amazing, but you put the wrong property manager or the wrong storage operator in charge of that deal and they can screw it up just as fast as, you know, too many times.
Yeah, dude. And for me, if you're looking at a deal and you can't pressure test and ask questions of the GP, and if everything looks like it's rainbows and unicorns, like to your point on a pro forma, but they don't have a business plan, they can't answer simple questions about, okay, well, what if that happens? Like, probably not the deal you should be investing in, man.
Absolutely not. Speaking of this, is that part of your coaching program too, the operations side of storage, or do you just help people on like sourcing and structuring the deals?
We have a 3-phase system. We call it deal discovery, which is how to find the deals, how to underwrite them properly so you have confidence to make an offer, deal structure, obviously the due diligence side of things, and how do we structure the deals, raise the capital, or I love seller financing when I can get it. So we talk about various ways to fund these deals. And then absolutely the operation side. I mean, one thing is acquisitions, which I find to be, for most people, I think that's where you need to focus on initially. But then yes, operations, if you suck at operations, and you shouldn't be the operator, you should find the right operator. But yeah, we absolutely spend a lot of time on how do you manage and how do you take over these facilities? How do you manage it properly so that you increase occupancy and increase the NOI, revenue rate management, and all those types of things, the different fee income that comes with storage. 100%, we spend a lot of time on operations, not just the acquisition side.
So why don't you dive into that a little bit more? What systems are you using to manage storage facilities today? We had a storage management system that linked with our gates. So like if somebody didn't pay, it would automatically lock them out. We had pricing analysis software that would help us like with the instant demand pricing and other things. So I'm interested to hear what systems are you using to operate storage?
Yeah, it sounds very similar to what you guys did. So we have a 3-prong management system. I typically, my buy box, Tyler, I look for facilities that are generally speaking 25,000 net rentable square feet and larger. I want facilities that generate enough revenue where I can plug in reputable third-party management that focuses on storage. Not that I don't have the skill set, I don't have the desire to build what you've built. In-house property management, which is a beast. To your point, it's not easy. So I look for facilities where I can plug in third-party management. Every facility we buy has a local boots on the ground team member. That person's responsible for lock audits, unit cleanouts, keeping the facility clean, taking pictures when we have to auction off units online. Very basic role. Those people get paid, depending on the market, anywhere between $400 and $600 per month. Now, before anybody thinks we're running like a sweatshop, these people work maybe 5 to 7 hours a week, right? They're on site once or twice a week. Very, very simple. And then the management company has a call center. The majority of our rentals come from people going to our website and checking out and renting a unit online. When they rent it online, they get text the gate code, they get text their unit number. And when they get there, they open up their rolling door and a lock is waiting for them there. Okay, so everything is automated for the most part. And then to your point, we used to be on StoreEdge, which is a storable product. It's basically a management system built for storage owner operators. And then recently we transferred over to Cubby. And Cubby is really good when it comes to the dynamic pricing, like the revenue rate management. And so that 3-pronged management system of boots on the ground, management company / call center, and then the management software is how we are able to manage and operate these facilities remotely, which is one of the things that really appealed to me when I was transitioning from wholesaling to storage. I said, I want a business that's high profit margin, low headache factor, that I can manage and operate remotely without necessarily having to hire a big team.
Flipping is hard, man. I've done quite a few flips over the years. It's never been like my primary business model, but if I've been one of those where if I see an opportunity and I can help somebody get out of an asset quickly, they need to get out of quickly and get them cash in hand or something, I'll do that and then I'll go in and fix it up and resell it. I've even built some single family homes and, like I acquired lots in a big portfolio or package or whatever, and then I built a single family home on a lot and sell it. I've done this. And the storage business is way easier than being a flipper.
Brother, I'm glad you said it and not me, because I don't ever want to cross as the guy that like is just beating the drum on storage like it's the coolest thing since sliced bread and nothing can go wrong. Look, every business you're going to have challenges and every business is going to have risk, but I would double down and triple down on everything you just said. To me, running a single family portfolio, operations, fixing and flipping, there are more moving parts and there's more complications in that than managing a storage facility remotely. Like 100%.
And it's easier to get people out of a storage facility than it is to get people out of a home.
Well, we got lien laws in storage.
Yeah, there's less regulations around it, and the stuff basically becomes yours and you sell it. That's something else I liked about storage relative to my primary business and I'm able to generate amazing returns on multifamily deals. I can find deals where I can force a lot of value through construction and through our operations and make a lot of money. The storage, a little easier to operate. I agree with you.
I think so too, man. And it's interesting. I want to pull on the thread. You used the words, I think you said force the value. And that when I learned in the world of commercial real estate, multifamily storage, the value isn't determined by the comps like it is with single family. You have more say on, as long as you can as an operator increase the income that asset produces, it's going to have an exponential impact on the overall value of the business. Versus in single family, you're kind of beholden to the comps. Yes, you can make improvements and do this and that, but you don't have as much control on forcing the appreciation on single family as you do with a self-storage facility or a multifamily property.
If you have a good business plan with commercial property, whether that's storage, you buy it right, you buy the deal right, you structure the deal right, and you operate the deal right. In storage, multifamily, any commercial, you can just make so much money so quickly. It's incredible sometimes, right? It could be screwed up as well. Wrong decision on the buy side, poor operations, but you get the systems right and you understand how to do diligence on the deals and only buy the right deals. You can force a whole lot of value into a deal really quickly, both in storage. I mean, our portfolio, we owned for less than 4 years. We had $7.5 million total into this portfolio, and we sold it for $11.5 million.
That's a crazy successful exit. Think about, so I don't know what the profit on that was, right? But multi-millions of dollars, like how many single family deals would you have to do in order to be able to achieve that in the same same period of time.
I mean, I'd have to probably flip 100 houses, and they all have to be good ones.
Exactly. And good luck
So-
batting 1,000%. Yeah.
Yeah, you're not going to, because I've had flips I've done where I've lost money.
If I had a conversation with a flipper who's done volume, like at scale, and told me they've never lost money in a deal, like, I don't know, man, I'm kind of looking at them side-eyed or something, but that's, if you've done a lot of flips, like at some point you're going to have a deal go south.
100%. Yeah, you're going to buy something that has something wrong with it you didn't expect, or has some environmental problem, has some weird thing that pops up in the walls you didn't expect. It's coming.
One thing that's super fascinating to me when I started really researching storage, and I realized that a lot of the owners that own these facilities, so I can jump on Google Maps and pretty much anywhere in the country, and I can find you facilities that don't have a website, don't have a Google My Business listing, are not doing any marketing, haven't raised rates. Sometimes I see facilities that don't even have a sign, no phone number, just nothing. And it's like, these are very basic business 101 things that you can go in, and it's a light value add, and now you can start to really generate significantly more revenue than what these storage facilities produce. And what's wild to me, Tyler, is sometimes when I come across these mom and pop owners that are not treating it like a business, and yet they're 90, 95, 98% occupied. Like, they're still making money. They're just not fully optimizing it. And so to me, that's low hanging fruit.
And it's very much the same with multifamily. You get people who own multifamily, they've been self-managing it for years. They're buddies with half their tenants, and they feel bad about raising rents on them. If you can buy these things at current NOIs at a little bit higher capitalization rate than what the stabilized market value is, which you usually can because those deals look like they have warts on them to a lot of buyers, especially the bigger players. You can get the rents where they should be, you can get the operations where they should be, and you can lower the perceived risk of the investment by fixing any of those perceived problems and make it easy for the next guy. There's just so much money in that.
Yeah, 100%. Brother, I have a coaching client inside of Storage Wins that's under contract to buy. I think she's paying 2.6 or 2.7 for the facility. The owner proudly markets and advertises that when you rent a unit, you are guaranteed to never have a rent increase. Like, the owner puts this on everything. She's literally advertising that you come in and you will never get a rent raise. I'm like, God bless them. Those opportunities are out there.
And I see that every day on the property management side. Person's been self-managing forever and they're wore out and they're sick of it and they want to hire a property manager, and they call me. I take a look at their rent roll and then I look at their portfolio and I'm like, what have you been doing? Man, these rents have been the same since 1995 and your taxes have doubled and your insurance has doubled and the cost of repairs has tripled. And at a certain point, they can't afford to keep these things up the way that they need to be kept up either. So it's really not doing a service to the end user of it either.
At all. It hurts everybody. Think about that as a business plan. I'm going to put a ceiling on my income potential, but yet every single year my expenses are guaranteed to go up. It doesn't make any sense.
Yep. Millions of people are doing it on these assets. And this is where it just comes back to the operator we were talking about. I want to get into that a little bit more about who you are as a person. We talked about that a little bit on our first call that we had. We got introduced because we're both members of the same mastermind group. That's how we came to know each other. I know your family is extremely important to you. I know having time to invest in that is extremely important to you. And I know your faith is very important to you. Why don't you tell the audience a little bit more about who you are as a human?
It's an interesting question, Tyler, because I remember when I was transitioning from wholesaling to storage, I struggled with the fact of like, oh, what are people going to think? And by the way, I shut down my business during COVID. So in my brain, I was creating a story like as if I was that important to people. I realized I wasn't, but in my brain that, oh, what are people going to think? Am I shutting down my business because of COVID? And what I ultimately ended up like realizing is that my identity is not what I do for a living or my business or my wins or my losses. Like, that doesn't define who I am as a man. And that set me on a journey to go deeper with my faith. You know, and I've always been a Christian. That's faith and family is what's most important to me. That's what drives me. Using this business and using the gifts God's given me, the platform God's given me, my ability to communicate and speak. Like, I want to impact people, and it sounds cliche and corny, but I genuinely have a desire to improve and help people. And I use storage and real estate as a way to do that. And this might sound crazy to some people, but I view my business as it's not my business. It's like God's the CEO, and it's like I'm doing my best to be led by him and what direction he wants me to take this, and how can I use this and the things that he's given me, because I'm just a steward of it, to impact people. And by the way, hopefully I'm not coming across as if I'm like preaching from the mountaintop, because I'm flawed and broken like anybody else, man. I make mistakes and I don't have all the answers, and I'm doing my best to just be led by him, and again, use the things he's given me to be a good steward of it. And my belief is when you're a good steward of the things God gives you, he's going to give you more to steward, and then you have the ability to now impact more people. So, and then my family, man, I'm sure a lot of people's why is their family. I want time with them. I want memories and experiences, not necessarily things. Not that there's anything wrong with nice things, but when I was in my 20s and early 30s, I was much more interested in things than I am at 46. We just got back from Europe, for 2.5 weeks, and like the memories to me are priceless. And I think that's what this business allows you to do, is to just experience more life. Because a couple years ago, I think it was 22 or 23, there was 4 people under the age of 50 that I personally knew that passed away. And sometimes it takes something like that to remind you that, brother, the next minute for us is not promised or guaranteed. Like, we don't know. And so like, play all out, take some risks that are calculated, do things to impact people in a positive way. One of my favorite books behind me, that little red book right there, is The Go-Giver by Bob Burg. And to me, I think it's Tony Robbins that said it, like, a life worth living is a life where you're giving and there's contribution. I get sincerely more fired up with other people's wins and knowing that I had a small part in their journey than I am closing the next deal or selling the next deal. Those types of financial wins. What you leave behind and how the impact you have on people, the character you display, your integrity, I think that's what defines a person, not the stuff you were reading at the beginning. Who cares?
Well, I look at listing accomplishments as more of building credibility. I know so many successful entrepreneurs. I know between podcasts, me going on them, me hosting people, being part of a mastermind, belonging to a couple country clubs, growing up with a dad who was a golf pro running a country club. I've spent my whole life around people who are very highly successful entrepreneurs. Nowadays, I feel like there's this perception around people who are really successful or who have made a lot of money or who have accomplished a lot of things, that they're like hoarding wealth or that they're like stealing from people or something like that. And what I find is that a very high percentage of successful business people and entrepreneurs believe exactly as you're saying right there. They want to be helpful. They want to add value. They want to help as many people as they possibly can. And that's why they scale their business, not because they just want to make more money. And a lot of them believe that they are a steward of God or the universe or whatever you out there believe, resources that don't really belong to them or they only temporarily are in control of them. There are so many. I would say the vast majority that I've met and talked to say something very similar along those lines.
That's been my experience as well. That's just me kind of sharing who I am, speaking from the heart. And what I find is that, again, for me, it's clear what my belief systems are. I believe God's going to continue to open doors and close the wrong ones and put the right people in your life for a reason. And I think when you operate with a mentality where you're not thinking transactionally, but you're thinking relationally, to me, raising relationship capital is the most valuable capital you can raise. Not money, not private capital. And when you can seek to build meaningful relationships with people without the expectation of something in return, it's pretty awesome how things just conspire to work in your favor, in their favor. It's, again, back to Tony Robbins. He always says, does life happen to you or for you? I'd much rather be somebody who's got the mindset that life is happening for me. And believe me, I've gone through some challenges despite what's going on.
Anybody who's done any level of business has went through things that most other people can't even fathom. I promise you that. I've also heard that from all those entrepreneurs I've been around my whole life. Almost every one of them has been to a point where they thought it was all going under, or shit was hitting the fan or they were in trouble. I will tell you, the ones who persevere and stick it out and get through that are all very secure in themselves, understand who they are. It feels so rewarding for them to have stuck it out and figured that out. And I want to go back to one other point you made about there are some people who are operating not in good faith or with bad intentions. I'm of the belief that those people, their hold on whatever resources that they're able to go get through like graft or fraud or whatever it is will be very temporary.
It's short term, 100%.
Because eventually that shit catches up with you.
No doubt about it. I completely agree with that. A mentor of mine did a post on Facebook, 2 weeks ago that got a lot of activity, a lot of comments, that he heard a guru share from a stage at a big event. If I threw out the name, I think a lot of people would know him, basically teaching people that a day or two before closing to go back and say you're not closing unless you're getting a significant price reduction. And my skin was crawling. crawling. And this person is like teaching this, like, hey, hold people's feet to the fire, get them pregnant with a deal, and a day or two before closing, hit them with this massive price reduction or you're going to threaten to walk. And it's like, and so he was sharing how he heard this literally in the middle. He walked out and he had this long post about it. And I was like, good for you, man. Good for you. That will catch up to that person.
I have people who I've brokered deals for, who I have tried to help cultivate and build a portfolio for, that will try to pull that shit. It's just always a me win mentality. And it's not a, like, I said I was going to do something and I'm going to do it mentality. I mean, to me, you're so much better off in the long run if what you say matters.
Do what you say you're going to do. You say you're going to do something, follow through.
We're very aligned from a values standpoint. I appreciate that. And like I said, I think I told you when we first met, I said, if you do ever have any good storage deals, feel free to let me know. I might be interested. So
I'd love to JV or partner with you or whatever that might look like. So 100%, Tyler. Thank you, man. I appreciate you having me on. Dude, I have a lot of respect for people that take their time and energy to launch something and have conversations and put out content. Like, you know this, man. It's work, man. And you do it. And yes, for some people, it's a lead gen channel, but it still takes time and energy and you're still putting out good into the world. And so for that, I acknowledge you, man, and I appreciate it.
You know, I actually love the podcast. I don't love all the social media work. That stuff is a little bit of a pain in the butt and it's a lot of work. It is good for business for sure. I love the podcast. I think it's really fun doing the podcast. I actually wish I had more time to do the podcast and spend talking to cool, interesting people like you about what you do and who you are. And I think it's so fun to hear people's stories.
Well, thank you, man. This was fun.
So one last thing before we sign off. If you're not subscribed or you do not watch Alex's podcast and you're interested in self-storage investing, go subscribe to his channel and watch the Storage Wins podcast. And then as far as your coaching program, if just one last thing here, tell people if they're interested in learning about how to do self-storage investing with you, what's the best way for them to get in touch?
Well, thank you, man. Again, I appreciate that. Well, first, I want to offer, I'll give you the 30-second version. Last year, I spent, 4 or 5 months, hired a copywriter, literally 20 grand creating a course. And my intention was to sell this course. I got to the end of the project and I'm like, what am I doing? Like, this is a complete distraction from my main goal. I don't want to go off and sell a course. So I decided to give away the whole thing literally for free, like 0 strings attached. So if you go to cashflowmaps.com, it's over 8 hours of training along with tools and resources, like dive into it. So cashflowmaps.com. And then, yeah, for anybody who's interested in storage, we have a community. My belief is that people don't need more information. I created that course because a lot of people are just not able to invest in themselves. And I want to be able to like put out good and give people valuable resources. But for people that want help with the implementation, I believe what takes people from where they are to storage ownership and start building a portfolio is a community of people that are pouring into them, that offer them support and guidance and can answer their questions and can give them the resources they need, provide a roadmap. So for anybody that's interested in having a conversation about that, storagewins.com/call, storagewins.com/call is a way that we can connect on a short 10-minute call so I can ask some questions and tell you what it's all about.
Sounds great, Alex. I've built a few courses myself. And I'll tell you, that's a lot of work too. And a lot of energy goes into that. But I did it because I had so many people reaching out to me all the time that were wanting to get into real estate investing. They were wanting to learn about it. When I first started, I would work with that person personally for hours and hours. And I would help them like get started. And I'd charge nothing other than whatever services we were providing to them for the deals they were doing. And we just got too big for me to keep doing that, had way too much volume of that. I'm going to put some of this into some simple courses I can send to people. I applaud you for doing that because it was way more work than I thought it was going to be to make something decent.
It was, man. That was a learning lesson. But to your point, you put a lot of time and energy. I felt very good about the decision that said, hey, I'm not going to go spend additional time and energy to sell this thing. Let me just give it away. Even if it just helps one person that takes the time to go through the whole thing, it would have been worth it, man.
Well, Alex, man, it was an awesome conversation. I hope you enjoyed it as much as I did, and I appreciate you coming on.
Thank you so much, man. Appreciate you as well.